Alrighty, thank you. It sounds a little weird because a little under the weather right now, so excuse my voice. Um, I wanted to show you guys pretty much my setup and different things that I do that make trading easier for me. And of course, you know, I'm not saying change your setup to my setup. I'm just saying, you know, my setup is a amalgamation of different setups from different people. So I've learned from everyone on YouTube. I learned from people that I paid. I learned from people that I didn't have to pay. I learned from professionals on Wall Street. And I took all of their things and kind of made my own. So I feel like, sharing this knowledge with you guys will allow you to do the same. If you see something that you like, you might can add it on to your setup and whatnot. But the first thing I wanted to talk about is gaps. I know gaps are something that everyone clearly knows about, but did you know that there's also gaps in candlesticks, such as this one? It's right here. And to show the importance of those gaps, because as you know, respect the gap. The gaps always get filled. It happens quite often. So right now I'm on the one weekly chart, and I'm just going to focus on the ES right now. Eventually I'm going to make a series of videos, but explaining why you should probably have all three indices up, but that's for later on. Point is, you see here, we're going closer back to all-time highs. You see that we had this long candlestick here, and we gapped up and closed the gap. And this week, we're still in this range here. But a gap is also any candlestick, such like this, where another candlestick, like this particular candlestick, so you have A, B, C. So you got A went up, came back down. Then you got B went up, and then you got C that continued the upward trend. So this is what we call a fair value gap. Now, I'm pretty sure you probably heard that term before. Everyone's running with ICT stuff, and they might call it something else. But this is what we call a fair value gap. And we say that because fair value can be found in this range. And so, as you can see, it just so happens that this fair value gap is coincide with these highs here, or some of you might call it resistance. And then it broke through resistance and it didn't retrace back to test to see if it was support. Support actually came up on this level here. So I'm going to start marking these off for you guys so you can see what I'm talking about. So you got right here, and then you got right here. And so in between this support and resistance level, you got this fair value gap that I think we eventually will come back in and touch this. We might come back in and touch this in the beginning of the year, like in February, March, April area. But I do feel like we're going to come back and we're going to fill this gap in and touch this resistance that became support and break this support. Because to me, this is not the actual support. The actual support is going to be these levels here. And so a fair value gap is any candlestick. If you do A, B, and C, and so you got A, B, C, any candlestick that if C did not retrace into the B candle, it leaves a fair value gap. Let me find another one. Like, for example, this is a fair value gap, and this is a small fair value gap. So you got candle A, you got candle B, you got candle C. Let me mark these off. So you got candle A. Let me turn off that magnet. Yeah, A. Click this one. You got candle A right here. Then you got candle B. Oops. Alright, guys. Don't worry, I'm trying to make these videos as simple as possible. You got candle B right here. Then you got candle C. Right here. Alright, so you got candle A, which is this candlestick here. Where got arrows? Oh, well. There we go. All right, so you got candle A here, candle B, candle C. A fair value gap is if price or if the candle did not wick or come back and touch candle A. So candle C has to touch candle A. If candle C and A do not touch, then there is a fair value gap within candle B. And so to show you how the market does and use these fair value gaps, as you can see, we kept going up, made a little fair value gap here. This is now candle A, B, C. If we're looking at this downward candle, it made a little fair value gap. And then this large downward candle that happened a few weeks ago, as you can see, it only went to right there to touch candle A. And so it touched candle A. There we go. It touched candle A and therefore close this fair value gap. So it closed this one and this one. So all this is now rebalanced and now we have fair value again. And so once again, I do think we're going to come back down here eventually. But like I said, the market is going higher and higher. And I feel like this is going to be a setup for next year correction. And to prove that, I'm going to show you something real quick because that's fair value gaps. And if you have any questions, feel free to reach out to me. We also have not the fib. Where is it? Right here. I also use percentages. So let's go from this here on up. This here on up to here. Okay. So if you look, the reason why I suggested that we may use this level as a retracement is because, as you can see here, that's only 10%. And the market's corrections, if you know, are 5 to 10%. You know, and then you got really a deep correction from 10 to 20%. And then you got bear market territory. And so I can definitely see the markets retracing back down to close this fair value gap, which is going to put us at negative 10% at the top of the year, at least in the first quarter. So not January. January is usually pretty good, but February, March, I think we're going to end up here. And today is October 23rd, 2025. And so I'll teach you guys a little bit about percentages in a little bit, but that's it. Fair value gaps. And as you can see here, there is an actual gap here, but the market's kind of touch tips here. So, you know, I'll explain that a little bit later too. But point is, that's fair value gaps. All right. Thank you guys.